Welcome back to the Manage to Win podcast. Today's episode is sponsored by Habitly.com, where you and your teams can learn the habits of highly successful people. These are the habits that people are applying to grow companies profitably and really get each person involved in meaningful work. They want to get up in the morning. They want to come to work. They're good at managing their time. They're good at setting and achieving goals. They're good at leadership. These are all things we teach on Habitly.com. Check it out. 7 days free. You can't go wrong. Today's episode is with John Gallagher. He's the CEO of Element SaaS Finance. It's a boutique growth finance company. They invest and lend to SaaS and other recurring revenue companies. He's from Ireland. I talked to him when he was in Texas. He's got some interesting tips on how to get your company financed, what that time frame might be to secure the financing, a couple options, whether it's investment or debt financing. Good conversation. Let's dive in. John, I'm really glad to have you on the show. Thank you for being on. And you are from Ireland, but actually talking to us from Texas. Your company finances entrepreneurs, it sounds like globally, but you work with a lot of SaaS companies. So what is the tipping point? What happens that really takes that company that's made a little bit of progress or a reasonable amount of progress, but then it just catapults them into hypergrowth?
Well, thank you, David, for having me on. Great to be here speaking with you. So what we see time and time again, and it's the entrepreneur founder story where they've created a product, they've won a bunch of customers, but they're at a tipping point where the product that they've created could service thousands and thousands of customers, but maybe they only have 100 customers. So at this stage, the founder is, wearing all the several hats that founders have to wear: finance, operations, sales, marketing, you name it. They're doing a bit of everything. And at some stage, they have to step away from trying to do everything. And they're going to bring in marketing and sales professionals to try and get the product that they have built and they believe in out in front of those customers, so that they can expand into those thousands of customers, not just 100. And that's really where the tipping point, the sales and marketing tipping point, takes the product and just gets it out there to the addressable market that they want to attack.
Interesting that it comes back to the team. Now, as you invest in companies, some people invest and they're kind of hands off. Some people invest and they join the board and they get involved. What is your model for success when you get involved with companies?
Yeah, and in today's finance market and in the fintech market, so much is based on data. And I think over the past few years, we have forgotten that it's people in the companies that actually produce that data and make those numbers change, and for the good and for the bad. So it's the founders and the management team that we want to get to know. We want to get to know how they're thinking about their business, what happened in those few months that were a bit off, or they'd hyper growth for a few months, and then what happened? How do they explain and understand and manage their business? So it's absolutely, the people is key. These people are, the founders. They've started and run these companies. They know every aspect of it. So we're usually very hands off, but we help out where we can. That's usually in the finance and strategy sort of arena. And we don't sit on their boards, but we certainly help them out in different aspects if we can. That might be it. If they're looking to do an M&A transaction, with particular skills, we can help them on making introductions to people, stuff like that.
And where do you typically play in the strategy side? Because I find that a lot of entrepreneurs get caught up in task-driven activities, and they kind of lose the strategy side. They're just, it's almost firefighting. So they can get a little bit of growth, but they can't really explode the growth side. And I think it's partially from what you brought up earlier. They don't add to the team, figure out where's that person who can take us to the next level. But when you talk strategy, and I'm thinking a financial firm, How do we help entrepreneurs realize that when you get the right financial firm, there's other things that come along with it, and the strategy piece can be really critical to open your eyes to things that you're not noticing or challenge some processes or the way you're focusing your time?
Yeah. Well, any investor or lenders like us, obviously we are privileged to have, detailed information about the company and access to the top management team who are running the company. So we're sitting outside the company, looking in at the company, and we're able to see what's going on. They're in the weeds. They're living and breathing it every day. And just that ability to come in, and you've got all this information and you've got all this experience of looking at hundreds of companies every year, you're able to sort of see, and get them to stand back a little bit. Well, guys, if you keep going like this is where you're going. Why don't you try a different tact? And that might be from a financial point of view, how they're looking, down the line, 18 months, 24 months down the line, where they're going to be, what people they need to get there, and what investment they need, because that's the business we're in.
So you must have had many people, if not hundreds of people, who've been able to overcome some pretty significant challenges. You've worked with them. Do you have kind of like a few stories that you'd like to tell us, real life stories of people that were able to really grow substantially, and explain kind of how that happened? Because a lot of times those illustrations are helpful for the audience to understand a little bit more clearly, moving down from the high level that we've covered so far.
Yeah, so a common theme for us is that all the companies we invest in are run and majority owned by the founders. So we have several customers that it's usually their second or third company. So their second or third time around running and starting a company. And in previous lives where they've run and started a company, they've taken on significant investment from venture capital and outside investment firms, where they got diluted down and they ended up owning 10 or 15% of their own company. But the trick that they often have got caught up on is that the investors that come in at a valuation, and it sets expectations. So they've got very high expectations. And if the founders don't meet those high growth targets and those expectations, the exit or the potential success of the company is going to be limited in the returns that they get, because they've been diluted, and the investors might have preferred options for getting money back first before a founder gets money. So a lot of times there's many examples I could give you of people that have sold companies for $50 million, $500 million, and the founders come out with literally zero.
Wow.
They walk away with zero. So founders are, that's not a good place to be in. So founders are realizing that, well, hey, what if I don't take the investment from these guys and I grow this organically, or use small bits of finance from time to time to grow my company, but I retain 95% of the company as a management team. And that's what they're doing. No, they mightn't hit the unicorn status that all the VCs or investors want. But instead of getting to 100 million, revenue, they get to $25 million revenue, and they sell the company, and they own 95% of it. So it's a great exit, and it's a life-changing moment for them and their management team and the staff. So that is a common theme that we are seeing, where founders are running these companies. They pour in their blood, sweat, and tears, and sleepless nights, and everything that goes into being an entrepreneur. So the chances of them having a successful exit is far greater under their own steam, rather than going down the VC route that want them to be a unicorn.
Yeah, well, I love your approach, because I've back in 2000 I got a $10 million commitment from HP for doit.com. That then went .bomb. But a year later they shut down the fund. They didn't tell us that, but they shut down the fund. And so they said we didn't meet the criteria and didn't complete the commitment. But, back then, they took 18% of the company for that exchange. And, that was in craziness with .com stuff. But it's one of the reasons I wanted to have you on the show was I thought that you had this approach where you weren't, I hesitate to say greedy, but, the VC model is so much like you mentioned, the unicorn. It's like, we're going to pick a company that can be number one, type of thing. Whereas you're being more realistic that there's a number of companies that can have very profitable business within a niche, right?
Well, that's it. And, look, VC, we need VC there because we need them to back the companies that need to be number one to make us successful. If you think of Google or Facebook or, any of these unicorn, there's only really going to be very few winners. So they need to go hard, fast at it, and they need a large amount of investment to get there. But that's for those companies. For many companies that won't be unicorns, they don't need that. So they can do it in a different way under their own steam, and the likelihood of success is exponentially better because they're in control.
Yeah. Do you have like a poster company that you'd like to explain what happened with them, with your investment and how they grew?
We don't often talk about our specifics of companies, but on our website we've a few companies we are allowed to talk about. There's one called Let Greens. It took our. It's a non-software company. It's one of our only non-software companies. It's a nutritional supplement. They took our money. They grew 120% in the year. And went on to raise, a large amount of money in a Series A. Another company based out of Singapore took our money and they bought out an investor of theirs. And 3 years later, they sold the company, and the founder who bought out the investor, who was 20% of the company at the time, reaped the rewards of backing himself and the management team. A great HR tool called Sphere. And again, but it's the management that we want to really get to know the people and the management and how they think about their business.
Yeah. So what are you seeing happening in the finance world out there as things are, changing with the economy? And so what's going on?
Yeah, absolutely. Well, look, the last few years has been pretty crazy time. We've all lived through a pandemic, which we would never have thought of. So what's happening now is that there is very much a pullback in the funding, mainly in VC and what they're trying to do. And while there is a pullback in the funding, it's mostly what's scaring off founders from raising at the moment is that the valuations have dropped. So valuations went a bit crazy through the pandemic. You were seeing valuations of 10 to 15 times revenue. And, in the last 6 months, that's dropped back to 5 to 8 times revenue. So founders are now having to reset their thinking process of how much their company is worth. And they're delaying that funding round a bit longer. They're tightening up their spend. They're pulling back on hiring and ads and stuff like that, and they're managing cash much better. But there definitely has been a pullback in the markets and valuations of all companies, not just SaaS and tech.
And if somebody wants to go out and raise some money, how many companies do you think they're going to need to talk to? And how long do you think that process can take?
Yeah, so for equity, you should be thinking 6 to 9 months. You should be talking to 10 to 15 at least. With debt, it's much quicker. So you should probably talk to 5 to 7, I would say. If you find the right 5 to 7, you don't need more than that. And the process should take between 1 month and 2 months. So it's quite different. But the main thing to try and understand is your strategy of and trying to get the right money. So there's a lot of short-term debt in the market at the moment, and it's very quick. So you can apply, you get it 3 days later, type stuff. But it's short-term money, so you have to repay it between 6 and 18 months. So your repayments are very high, and if what you're using that money for is a longer-term investment, so say you're hiring salespeople, usually take salespeople 6 months to really get going and build their book of business and get out there and start paying their way. So that can be good. Sometimes it's 12 months initiative. And I liken it to trying to buy a car on your credit card. We can all go and do that, but it's probably not the smartest thing to do. You're probably better getting a car loan. It's the right finance for the right use, and so that's refine your strategy and have the right strategy in mind before you go out and talk to all these people, because otherwise you're wasting your time, and you might get the wrong finance and find yourself in a bit of a sticky position then having to refinance that.
Yeah. So what do you find that it's the biggest mistake that companies make when they're going after finance?
We see a lot of companies that say have historically been growing 40 to 50%. And then you see their projections, and their projections like straight away are, they're going to grow at 120%. And when you dive into, well, how you've been growing at 40 to 50% for the last 3 years in a row, how are you all of a sudden going to grow 120%? That's not an easy thing to do. That's the old hockey stick approach, and be realistic. Debt providers, what you're going out to in your forecast and your model is different from what a VC will want to see, because VCs will write huge checks and you can burn loads of money. Debt, you have to be much more considerate of what you're spending money on and your cash runway and stuff like that. So tailor your approach to the person you're talking to, and be considerate of, look, this is what we've done in the past. So if you're changing, if the business is going to change fundamentally, have it well worked out of why it's changing and how it's changing, so that you have a backup. You're able to back up your claim that you're going to increase growth.
And do you recommend that they find a partner that also adds some strategic value or has some connections? Like, I don't know, do you have go-to partners in that work with your company, whether it's, to help ignite some social media marketing, or somebody that's an expert in developing a sales program, or are you really, tailoring where you're encouraging them to then go hire those people full time versus getting started with, maybe some consultants that you have in your group or connected with your group?
Well, we certainly help out wherever we can. You find that a lot of the time when people are, founders are getting into hiring and exploring different ways to grow, it might be, say, marketing, they often will go down the contract route, get an agency in, or they're dipping their toe in the water before they start swimming and hiring a big team. So we certainly help out wherever we can, but founders usually are very, very resourceful people, and they have great networks, and they usually don't ask us for a lot of help on that stuff. But we certainly, from the finance and the strategy side, we're getting involved and helping them out. And it might be a bank relationship that they need. Absolutely, that's up our street. Might be legals or tax or something like that. We can help them. An M&A process, how to prepare for those sort of things. That is stuff that we help out all the time.
And what's the best way for them to identify who's going to be a good financial partner for them? How do they find find people? Is it something where, if I know about you, I'm going to meet with you, I'm going to see whether we have some synergy. If we have some synergy or we don't, then I'm asking you, who else do you recommend that I speak with? Or are there other avenues for me where do I find people like you or other people that are involved in the finance industry who might be capable of, getting involved with my organization?
A lot of the times it's referrals. So, they'll have friends who have done certain things, and they'll say, speak to John or speak to David. I've dealt with them in the past, and they're good people. But like every relationship, when we start off talking to a company and the management team, you have to build that relationship and trust, and belief that you will follow through on what you'll say you'll do for them. And we often get asked for references. So happy to give references of past people, good and bad situations that we've been in, that we're able to show that we do follow through and in what we say we'll do, and also in the way we act. And it's like the hiring process. If you hire someone, it's interviews and CVs are all very well and good, but it's really when you start working with someone day in, day out, that you really get to know them and figure out how you're going to work together.
So am I understanding it correctly, John? Then it's I'm going to get to know you. If there's some synergy, I'm going to start. So are you saying that maybe I might start monthly sending you finances, or monthly having a conversation saying, here's how we're progressing. So I'm, following through and developing a deeper relationship?
Yeah, well, we've done that. We do that all the time. But it can also be a fairly quick process. Like, as I said, it can be, 4 to 8 weeks process of getting to know someone. So it can be quite quick. But you're getting to know the founder, you're getting to know their management team, and you're going through their business with a fine tooth comb. So, there's a lot of questions. There's a lot of answers that they have to give, and explanations that, might be good or bad or difficult. And in those conversations, you get a sense of the person and how they run their business. But it can happen very quickly.
What are like 3 key things that you look for to happen as you're having those conversations over 4 to 8 weeks or longer?
3 key things: the ability to talk about their business, their product, their financials, shows an in-depth knowledge of exactly what they do on the fly. It has to be as you're speaking, that they know this stuff. It's not, they've gone off and done loads of research and found the answer. They should know a lot about their business just intuitively. That's key. Other things that we look for: consistency, and being upfront and honest about situations or something that's happening. So, for instance, there might be a legal case against the company. Well, just be upfront and honest about it, because we're likely going to find out about it in our diligence. So, that builds relationship. You get to know people and you work through those things together. So those are the 3 key things I look for in the people that are running the business.
Yeah. And elaborate on the consistency piece. What does that look like?
Well, consistency in that, what their business does. Have they been building the business consistently over a period of time in a sort of considered approach? Whereas they're haphazard. Like, 1 month they're pouring money into ad spend, the next month there's a new office, the next month they're turning the ads off. Like, consistency in their business, but also in the way that they talk about the business, the management team. Like, okay, so they hired a VP of finance last year. This year it's a VP of marketing that they've hired. They're building their bench of management team in a very consistent, considered fashion, which really makes a lender feel comfortable, because we're not going for the VC moonshots that have to do some crazy things maybe to get there.
Have you ever started that relationship with a company and they're kind of, at least the founder is hitting on those three items for you? However, it becomes clear in your discussions that there's a member of their leadership team that's not working out, but the founder hasn't had the guts or the insight to transition this person off of the team. Have you ever been in that situation? And if so, how did you help that discussion proceed and some action being taken?
The only example that I've had in this business, an Element running Element with our own customers, was we had a customer that got rid of their CFO very quickly, and it was the CFO that I built a relationship with. But the founder, just they didn't get on well. So we'd already lent to them. It was good business, So then I had to try and develop the relationship with the founder over time. They'd be sending us monthly financials, so I made sure that we hopped on a call every quarter. I asked a few questions. Just start engaging with him more. But at the end of the day, there's very little we can do if a CEO decides that they're going to change their team. That's their prerogative, and we don't have any say in that, really.
Isn't that kind of a yellow flag, though, when they get rid of the finance person that you're working with? Because sometimes that could indicate that there might be, doesn't sound like it in this situation, that there could be some shenanigans going on, or the founder wanted to do something that the finance person thought was imprudent.
It certainly would be, yeah. And look, all of these sort of soft points are absolutely indicators that you have to watch out for. In this case, I think that they hired a CFO too early. They didn't need a CFO. CFOs are usually expensive. And they needed a controller, maybe a VP of finance, but they didn't need a CFO. So I think they actually had hired him too early. And the CEO eventually realized that six or 9 months down the line, and made the change. But I'm not sure how their relationship was going anyway. But I would say that it was because that the CFO was really underutilized because the company didn't really need a CFO.
Yeah. Now, you've also been driving your company 150% growth year after year for I don't know how long. What have you been doing to really grow your organization so rapidly?
My background is very much finance and investments, and I've got a steep learning curve in all things sales and marketing. So we've been doing lots of marketing. We have a very senior marketing lady who's fantastic. So we've been doing lots of different marketing, some digital spend, SEO, content writing, conferences, podcasts, all of these things that you have to add to your bow. So I've been learning a lot of that over the last few years, and getting more and more involved, and developing relationships with the broader sort of SaaS and investment community that would be where our clients would be. We've added people to our team, just as I mentioned earlier, that CEO wears many hats. We can't always do all of those things. So we've a business development director joined us, and I have 2 associates that work with me on the credit side. So again, like the companies that we lend to, we've been broadening our expertise and team to help in that growth.
Well, that's great. So, John, if people want to learn more about what you're doing, where do they go?
elementfinance.com. Many ways to get in contact with us. So, and lots of great material there as well to help founders as they start thinking about finance and how to fund their company.
Okay, fabulous. Well, thank you so much for being on the show. I really appreciate it. This has been great for the audience.
Thank you, David. Thank you for having me.
Thanks for tuning in today. If you liked the episode with John, we'd love to have you subscribe, invite your friends and peers to subscribe, leave us a comment or a rating. Love the feedback. Please don't forget our sponsor, Habitly.com, where you can take your strengths and make them stronger. You can take areas that need some improvement and get those improved. I was going to say fixed, but that's too strong, right? But you take an area of improvement and you make it so it doesn't hurt you, okay? Some people call it a weakness. I'm avoiding that term. Anyway, thank you again for joining us. Stay tuned. We've got more great leaders coming on, and they've got some good insights for you. Bye for now.